Welcome, everyone. Thank you so much for joining us for today's webinar. My name is Julia Becker with the content marketing team here at FreightWaves, and we're very happy to present our first webinar for our point of sale community today in partnership with ArcBest. Today, we'll be providing an overview and recap of Q1 trends in retail and a forward look as we prepare to enter Q2. I'll be joined by Andrew Cox, Senior Retail Analyst and Head for the Point of Sale Community for FreightWaves, as well as Dennis Anderson, Chief Customer Officer for ArcBest, and Matt Waller, Dean of the Walton College of Business at the University of Arkansas. We'll also be saving time for some questions from those of you in the audience following the discussion. Before we get started, though, I'd like to cover just a couple of quick housekeeping items. First, if you have any questions during the webinar, please feel free to reach out to our team via the audience chat function in your webinar console. And if you have any questions that you'd like to ask our presenters, you can enter those through the Q&A box also in your console. We'll answer as many of those as we have time for at the end of the live Q&A. We'll also be sending a link of this recording to you tomorrow using the email that you registered for if you'd like to watch it on demand or share it with your colleagues. At this point, I'll go ahead and turn it over to Andrew to kick us off on today's discussion. Great to have you here today, Andrew.
Thank you so much, Julia. And thanks everybody for joining us. Thanks everyone from the retail community, point of sale, for joining us. And thanks to anybody who's not in the community that is joining us today. And also thank you so much to Matt and Dennis for taking the time out of your day to do this with me. I'm very excited to share a lot of the insights and data that I've been compiling over the last 3 months to give us, a look back at the last 3 months, but also a look forward at what is to come. All right, so as Julia said, we are going to do a Q1 recap, so I'll run through this pretty quick because I do have quite a few slides. So the Q1 recap, we're going to talk about foot traffic, where that is right now, also talk about some of the consumer trends in spending as well as sentiment and the consumer balance sheet. Then we'll get into the good stuff, the freight supply and demand, as well as freight cost. And then we'll have a discussion on inventories, and that will lead perfectly into port congestion because that is one of the biggest short-term trends in retail right now that's having a huge impact. We'll also talk about how retailers are reassessing their existing fulfillment networks to get closer to the end consumer as e-commerce has exploded over the past year. There's also, there's a multi-speed supply chain emerging right now between delivery speeds. There's also a movement away from wholesale towards more direct consumer. And then lastly, we'll finish the conversation with COVID happened. There's been a bunch of things that have changed. What is going to stick? All right, so on to foot traffic. We have had foot traffic improving over the past, few months. But we're still well behind pre-COVID levels. So you need to disregard the very last leg up on the far right axis of this data. It is becoming to be distorted by the fact that we hunkered down in our homes at this time last year. So you're seeing year-over-year improvement, but that's a little bit artificial. So we're down about 30% for most categories. Home improvement and electronics have been foot traffic winners throughout COVID. They are the blue line there at the very top and the orange line. But again, this is also going to be a theme throughout. There are so many uncertainties ahead of us. Forecasting is critical, but it's also extremely difficult right now, and there will be errors. If you're looking just ahead at the next few weeks, we have the vaccine rollout moving right along, but we also have cases beginning to pick up for the first time in many weeks. And we have warmer weather ahead. So the idea of where foot traffic is going is very difficult to determine right now. We do have some regional disparities in regions where there's warmer weather and there is less COVID restrictions, social distancing restrictions, like in the South and the Southeast. We're seeing better foot traffic there than on the West Coast and in the Northeast. But when COVID restrictions have been leaned out, we've seen a pretty solid surge in foot traffic in areas like California and in New York. So let's toss it over to Matt. What do you make of the foot traffic recovery right now? Matt, do you think that the higher e-commerce penetration that we've had and the changing fulfillment methods is keeping people out of stores, keeping this foot traffic a little bit artificially down, or are people just simply waiting out the virus?
Yeah, I think that, by the way, there's so much noise in the data right now. It's hard to know exactly what's happening, but many people who didn't use, for example, pickup, retail, say grocery pickup, a year ago, are using it now. And even when they can go into the store, Many times they're not. And there's all kinds of things going on with consumer behavior that are very out of the ordinary. So, and also unexpected. Order online, pick up at the store, and then go into the store maybe to get, produce, for example. So they're using a combination of things in one trip.
And Dennis, what are your customers saying? Are they, especially in the value segment, I've seen big expansion plans, brick and mortar expansion plans in 2021. Are there any big takeaways you've had in regards to foot traffic with your customers?
Yeah, it's interesting. I mean, we definitely are seeing some similar trends to what you're showing here. I mean, I think a couple of years ago we were talking about the death of brick and mortar. And I think what's interesting about the pandemic is that it has, as Dr. Waller said, it's really maybe made brick and mortar a little bit more important in a different way. And so that's, we've seen from the beginning of the pandemic, we would have customers that didn't have a great e-commerce strategy or didn't have a multi-pronged e-commerce strategy, really be subject to the shutdown early on in the pandemic. Now those locations largely have reopened, so we're seeing some pickup there. But I think we're going to get into a little bit later just what's going on with those options that consumers are getting, and we're definitely hearing that from our customers as well.
Yeah, it's great that you mentioned that. BMO Capital Markets sent me a report that they did recently. It was titled, "Did COVID Actually Save Retail?" And we'll go through some of those topics throughout this presentation. But there was plenty of bad in COVID. Don't get me wrong. Much bad. Sales down 20-30% year over year. But there were plenty of good as well. Many silver linings that big companies that sell a lot of product make a lot of revenues realize that. At this point, why are we selling so much and not making enough money? So we'll get through all this throughout the presentation. I have a bad tendency to get off track and get ahead of myself, so we'll keep pushing forward. All right, so let's get on to consumer spending a little bit. We've been on a roller coaster to start the year. If I call January by anything, it was a little bit of a sugar rush. We had the stimulus come in and make an immediate boost to the consumer economy. Total card spending is that TCS. You're going to see that acronym come up throughout. But this is data from Bank of America. They put out one of the best weekly consumer reports that I read. So you're going to see a lot of this data. But things to take away from the January stimulus: that a higher marginal propensity to consume. So that basically fancy economic terms for we're spending it at a faster rate than the April stimulus. I think there's a couple reasons at play here. One is that I think Americans at that point did feel a little bit more secure than we did back in April with no idea what was ahead of us. And then also I think the fact that it was just a little bit less money made people a little bit more willing to spend it faster. But it was spent on goods. That was one big takeaway, is that it was still being spent on goods. Services were still widely unavailable. And I was really encouraged to see that Americans were buying clothes again with this stimulus. It was one of the biggest winners of the first stimulus was the clothing segment. Overall, January was pretty strong. Retail sales came in, I think, up 5.3%. And here on this bottom chart, you can see, so chart 10 on the bottom here, this is just the change in spending based upon the stimulus. Clothing, online electronics was another big winner. You'll see that theme throughout. It has continued to be a winner on into March. But I'm going to skip on to February, because as we had a roller coaster, we had a freeze in February. There's some pretty easy explanations for it. So this is the credit card and debit card spending data. You can see this kind of downward turn on the far right axis there in February. And so we had a few pretty easy explanations for the weakness. We not only had a blizzard that shut down. People forget, everybody always talks about how California is the 4th largest economy in the world if you were to break it out by a country, but Texas is the 10th, and the 10th largest economy in the world was shut down for a week or more. So it makes a big impact on spending. So the blizzards, we also had delayed tax refunds. Here's some blizzard impact. Sorry, I'm forgetting my animations, but some blizzard impact. So states impacted by the winter storms in dark blue there, spending just plummeted 25% in the matter of a week. Here's some online retail data just to prove that it wasn't just in-store, it wasn't just brick and mortar traffic that declined. It was also online data. The economy was frozen for a point in time. And then here is delayed tax returns. So 2021 tax returns have been delayed quite a bit. People are pointing to this as a reason for weakness in February as well. But we did have a fairly rapid post-storm recovery. Texas picked up quickly. If you looked at the outbound tender volume index in Texas, it surged back up well above pre-storm levels within 10 days or so. And retail sales ended up coming in down 3% in February. Dennis, you want to talk about the storms for a little bit? What kind of impact that they had on capacity networks? What the difficulties were. There was like 8 major highways that were shut down for a few days. So what kind of disruption did it have, and what were the challenges of getting that work through?
Sure, certainly. I mean, I think the storm definitely had an impact on transportation networks' ability to serve those areas for sure. We actually run LTL network. We also have owner operators in our expedite operation, and then we have carriers in our truckload operation as well. And so all of those modes, regardless of the mode, the winter storm was agnostic in the way that it impacted all of transportation flow. And so, I think what we talked about actually in an 8K or a 10K in February was just seeing that drop in February for sure in our business levels, really across the board. For us, we're able to, with that expedite operation, we're able to get back up and running pretty quickly, and be able to start moving freight in and out of those areas fairly quickly. But definitely, it was disruptive to operations of all kinds, and any transportation network in those geographies generally would have been affected by the storm, but we definitely saw that in operation as well.
Yeah, it must be so beneficial to have the different modes within the portfolio of ArcBest to be able to lean on when times get tough and freight networks get disrupted by things like storms. So let's move on to March, because March has been unbelievable so far. The stimulus is having an incredible impact on the consumer economy. There we go. Okay, so we're also beginning to get the 1-year base effect, the distortions, because this time last year we stopped spending money, we all hunkered down in. So you're going to have the 1-year and the 2-year change on these charts from Bank of America. I believe the lighter is much more meaningful right now. You can see that surging up to 23% over 2019 right now. So total card spending in the most recent week of data is up 23%. And so that's in aggregate. If you break it down by stimulus recipients and non-recipients, stimulus recipient spending is up 49% over 2019, while all others are up about 10%. And another staggering number here is that recipient spending is up 40% over the February average. And what we're spending it on is still big ticket goods. We're still spending it on a lot of goods. So we are seeing some reversion back to services, but I do believe this will be gradual. I think that first stage is underway. We're seeing Americans pare back their grocery spending as they exchange that for more restaurant spending. Restaurant spending is actually up low single digits over 2019 for the latest week of data. But I also think one of the aspects here of why we're continuing to spend on big ticket goods is the work from home. I don't think that needs to be overlooked, because the things that we're continuing to buy, furniture, online electronics, these are things that are beefing up our battle stations, because work from home has been a success for a lot of people. And I think that as we're all working from home right now, I think this is going to be a hybrid model at the very least. And people still don't have those workstations and built out as to where they like them. So they're continuing to spend on furniture and online electronics. That was a little bit surprising to see for me. But Dennis, we spoke about this. Spoke about this on the podcast that I had you on. But it's, I know you guys have many other brands, but the LTL is in particular very exciting. Is interesting here because it's poised for growth and is there to take advantage of some of this e-commerce growth, especially when it comes to delivering furniture and bulky home items. How is ArcBest creating services to utilize and take advantage and flexing some of this LTL capacity to take advantage of e-commerce growth?
Well, certainly, Andrew, and as you mentioned, we talked about on your podcast a few days ago, just the flexibility of LTL as a mode, particularly responding to these e-commerce trends, and particularly with final mile delivery of these big and bulky items. Obviously, a lot of the final mile discussion, and particularly for retailers, revolves around parcel. But in the case of these larger ticket items, which have become more and more of a, as you mentioned, more and more of a point of emphasis for consumers over the last few months, as people look around at their setups and want to change, even not necessarily even just their work from home setup, but maybe I think the housing market has even seen a pretty big move in the last few months, as people just look around at their surroundings and say, is this really how I'm going to live going forward? And so what do I want out of a home? So there are a whole lot of reasons why these particular goods have been really moving. But I think, back to your point, LTL is a great mode for agility in this space, because LTL plays a role for a lot of retailers, suppliers in the first and middle mile, but then also in this final mile proposition as well, when there aren't other options like a pickup from a store or curbside, and especially a lot of these larger bulky items, there needs to be a final mile delivery. And so whether that's some local operation, or whether that's an LTL network like ours, or even some coordinated overall solution that's connected through the first, middle, final. It's, as you mentioned, it's great to be part of a supply chain organization that can do all of it. But we've definitely seen the impact of having those services and being able to offer those services to our customers as these demand patterns have really evolved over the last few months.
And Matt, thinking about along the lines of demand planning, I mean, this is with as much uncertainty in the market as there is, this is one thing that seemed to be kind of predictable. We knew that there was going to be a big stimulus package passed. We knew that it would be coming in March when the weather was warming and people were getting ready to go outside. Should retailers have been expecting this big surge, and what could they have done to prepare for it, to make the most out of it?
Yeah, well, that's a good question. First of all, from a demand planning perspective, when we have stimulus, we have the freeze, we have the Suez Canal problem. All of these things create uncertainty for retailers, not only retailers, but the suppliers to retailers. And so right now, when you see this surge in demand, it's creating the bullwhip effect. And the bullwhip effect has a huge impact on demand planning. The bullwhip effect means that when you have an uncertainty increase at the lowest levels of the supply chain, say retail, e-commerce, that uncertainty and variability is amplified as it moves up the supply chain. And so, a lot of people say, for example, we won't see the effects of what you could call March Madness or the Suez Canal problem for 3 months. But actually, we're seeing it right now. It's just not as obvious. Because what's happening is a lot of retailers and suppliers to retailers are actually over-ordering right now. This happens throughout history. When you get these kinds of shocks to the system, people overcompensate, and sometimes they'll place orders bigger than they need to try to get more of their fair share of allocation. That is, when product is on allocation, some suppliers will allocate how much product goes to various customers based on the size of their orders. So sometimes customers will overstate their orders to be able to get a bigger portion, and that uncertainty then gets pushed up the supply chain. So to Dennis's point earlier, I think he was spot on. There's going to be more need. You're going to see a lot of product that would have been moving say in truckload that will be moving LTL, and you'll see a lot more expedited shipments, because when the effect of the bullwhip on demand planning is that it makes it much more difficult. In this case, it makes it nearly impossible. So people need to move product in short periods of time.
Yeah, there are so many things I want to respond to on that, but I do want to keep the train moving because we got Q&A ahead, and we've also got an inventory discussion coming up. So I definitely want to get back to, inventories, people over ordering if they can order right now, if they can get things into the country. They're certainly taking advantage of that. I know Costco is one big retailer that has said they're trying to front load as much as they can if they in whatever products they can get in right now. All right, so this is the big question, and this is one that I've been battling with, and I've been changing my mind over the last few weeks, and it's that can goods demand remain strong upon economic reopening? Because I do believe that there will be a generational release of pent up demand for services upon the second half of the year. People are, I think, itching to go on vacation, to go to concerts, go to sporting events, all the things that COVID has deprived us of, and all of those things don't move much freight. So that's a negative to the freight market. And so the question is, can goods demand remain strong when services demand really picks up in the back half of the year? And at first, I thought that answer was no. But the closer and closer we get to it, the more I'm leaning yes. Because of the stimulus, that's definitely a big factor in this. The U.S. savings rate is double what it has been for the previous 10 years right now. And it's going to surge even higher when we get the March data in. It'll probably surge back up towards 20%. And consumer sentiment is at its highest point in a year. And it's moved inversely of COVID trends throughout the pandemic. When we've had highs in cases, we've had lows in sentiment and vice versa. So with COVID trends moving in the right direction, I suspect to see this continuing to improve as well. So there's a long way to go, but the vaccine rollout is moving forward. And in Bank of America's most recent consumer report, they stated that they believe their 7% real GDP growth rate for 2021 might be too low. Dennis, what type of accounts at ArcBest are growing the most for you guys right now, and what do you expect to see that over the course of the year change? Do you expect to see consumer accounts continuing to be the big growth spaces, or maybe there's also a lot of demand from industrial peaking up, the housing market? We're definitely going to get into some of the other demand drivers when we talk about freight demand and supply. But what do you say? Are the accounts that you see are growing now going to change throughout the year?
Well, I think, it could shift if there's and I think I want to respond to something you said there earlier about goods and services. Services do still move freight. It's just in different ways. And I think one of the things, the examples that ran across last year in the shift from that just happened immediately from services to goods was just the idea that a restaurant, for example, would need different types of food shipped to it than your home would. And so a consumer buying certain types of food, the food would be packaged differently. It might not be in bulk, but not just food, but some of the utensils. So restaurant supply is an interesting discussion there with services versus goods. And so I think it just moves freight differently in a services type environment than goods. But some of the indicators are still very strong on the manufacturing front. So we look at the ISM PMI quite a bit to look at what's going on with manufacturing over the next few months potentially. And that indicator's been very strong. February was up above 60, which is a pretty aggressive growth territory for that index. And so, it certainly looks like from some of those indicators that we've got some runway here in the goods economy. But I wouldn't automatically assume that, once that there's a dramatic shift, or if there is a dramatic shift, that all of a sudden changes the game for freight networks or for freight demand. I think it just shifts it into different channels, which does create some ripple effects. And I love Dr. Waller's discussion of the bullwhip effect, and I think that is definitely possible as we move through here as well over the next few months.
Yeah, you're certainly right. Different types of freight moving. I think I heard Kyle Littner talk about this the other day from K-Ratio. He was saying that, $100 at a restaurant, $100 at a grocery store, not as much freight being moved at the $100 at a restaurant, but definitely other things, utensils, textiles, certainly other things. Matt, what about you? Do you have any thoughts on the question about goods demand versus services demand, when the broader economy reopens?
Yeah, I think one of the reasons the marginal propensity to consume has increased is because the balance sheet of consumers has improved. So the question is, how long will that last? But I think there's going to be continued strength in overall goods and services because of the kinds of products and services that are being demanded, and because of the balance sheet of consumers. I do think consumers are being cautious, but the other thing that's happening at the same time that I think is being masked a little bit by this is baby boomers who are between the ages of 56 and I think 72. Many of them, especially on the older end of the spectrum, are transferring wealth. Some of them are there's inheritances, there's trusts that are formed, but we're entering a period where there's a huge transition and transfer of wealth from one generation to the next. And I think it's the biggest wealth transfer in the history of the country. That's another thing that will keep the marginal propensity to consume high, I believe.
That's a great point. Yeah, I know I've been seeing charts all over Twitter these days, all the millennials talking about how little percentage of the wealth they have at a certain age compared to what the baby boomers had at the same age. So there's lots of upset millennials with that chart online. Okay, let's move on to the good stuff. So freight demand, it is near all-time highs. We've got freight flowing from every corner of the supply chain. And there's demand drivers everywhere you look. So as we've been mentioning, we have a very cash-rich consumer. The balance sheet on the consumers is as strong as it's been in many decades. We have very depleted inventories, and we'll save most of the inventory talk for the slide on port congestion. But inventories are extremely depleted at its lowest point in 29 years on a sales ratio basis. As Dennis said, we do have a blooming industrial recovery. ISM PMI hit 60, which is its highest point since 2018. And the home builder sentiment is extremely strong. It's fallen down from an all-time high in November, but remains very high. If anybody's tried to buy a house in the last 6 months, you understand how hot the housing market is. And I think this plays on also what Dennis was mentioning earlier was this deurbanization, working from home effect. I think they're working in tandem with each other. It's also increasing goods demand. So I guess I'll ask a question to both of you, and it's if we're talking about the thesis of strong demand throughout the end of the year, that's a thesis I'll propose to you. What could derail that thesis? We'll start with Dennis.
So I think one of the things that causes transportation to be a very cyclical business is just the ultimate balance of supply and demand. And so, I think if demand were to slow, and at the same time, we're seeing capacity enter the market, you're going to cross those curves at some point to a place where then supply outstrips demand, and you get into a different freight environment. But the confluence of things that you just mentioned on the demand side, I've not seen that in my career, and it's all really driven by the what's going on with the consumer at the end of the supply chain, and just those changing behaviors. As we've gone through the pandemic, and then now hopefully as we're seeing the sunset on the pandemic, to overuse a word, it's unprecedented in terms of the confluence of those demand factors. And so it's hard. Obviously, crystal balls are non-existent these days.
Absolutely.
But it's really difficult to see, where that point is. I expect that at some point there is a reversion to the mean as capacity catches up to demand, but there are a whole lot of factors on the capacity side conspiring against that as well. So I think we may talk about some of that in future slides as well.
Matt, do you have anything to add on that? Anything to derail?
I totally agree with Dennis. I'll tell you what I'm afraid of is inflation. We are experimenting with federal spending, and if you look at the balance sheet of the Fed, it's incredible how much it's changed. You would think we would have inflation. We haven't at many times when we thought we would, but you're asking for what could derail it. I think that the confusion associated with, serious inflation, and again, I hope it doesn't happen, I think could cause derailing. It could cause all kinds of problems, including high unemployment. So hopefully that won't happen. But that's one thing that could derail it.
Yeah, I think that's a great point. I think it's a great point, Matt. I read the other day that 22%, I think was the number that's sticking out in my head, 22% of all U.S. dollars printed in the history of the U.S. dollar was printed last year, which is unbelievable. And we definitely are seeing inflation, but it's in asset prices, it seems, or is the only place we're really seeing that show up, but not in consumer yet, unfortunately. But I agree, if we have further stimulus ahead, which the Democrats in the House are, speaking to trying to pass another bill at some point. So if we have further stimulus, if this constant stimulus goes on, that is certainly a worry. But I'm not an economist, so I don't want to get too far off the rails here. But okay. So here's capacity. There is relief ahead, but how much and when it comes is still to be determined, as much is in this environment. It did seem that freight networks were finding a groove there prior to the storm. We were seeing the outbound tender rejection index, our measure of relative capacity. We were seeing that decline steadily prior to the winter storms. But, just like, I'll get to that point in a minute, but demand patterns, this is something that you mentioned to me, Dennis, was that demand patterns have shifted and they continue to shift. But, it seems that freight markets or carriers have optimized for the West Coast, and then the West Coast got so crowded you couldn't go into the West Coast. They shifted to the East Coast, and now we have the Suez Canal blockage. There's just so many things going on. So, Dennis, what do you? And then also we'll talk about. Sorry, I'm getting ahead of myself, but on the capacity relief ahead. So in 2020, we had a slew of early driver retirements. The Drug and Alcohol Clearinghouse also wiped tens of thousands of drivers from the road. We've also had very tight bottlenecks at the driver training schools. The last report I read was in October, and they were at about 57% capacity of pre-pandemic. And we've also seen driver wage inflation, which points to me that carriers understand how difficult it is to seat trucks, and they're looking to maintain the good drivers that they do have. But Dennis, you and I spoke offline that the orders data is a little bit convoluted when you look at the deliveries data. So what do you read through all the noise in this equipment data?
Yeah, certainly. And I go back to a point. First of all, we've talked about driver shortage for a lot of years now. maybe as long as I've been in the industry, I've heard talk of a driver shortage. But 2020 was, I think, unlike anything that we've ever seen, and because of the factors that you mentioned with some of the attrition, but then also the slowdown in the entry of drivers into the market. So that's definitely a factor that I mentioned earlier would be conspiring against a capacity recovery. The other thing that's interesting to note is, we've seen orders jump for Class 8 tractors in the last few weeks, but there's definitely a lag effect on production. And, production in the last update that I saw was still actually below year over year numbers. And, there's an effect that, last year, a lot of carriers were not ordering at replacement just because they're in a cash preservation mode. And so you could be seeing some holdover orders from last year that might have been intended to get them back caught up onto a replacement cycle here earlier this year. But I think Dr. Waller mentioned the bullwhip effect, and that's actually apparent here because you have carriers trying to get in. This is the theory that you have carriers really trying to get in with their orders now. To make sure that they have slots, because production has got to catch up at some point. But you'll have some cancellations. There'll be some things happen there. So it's really, even the Class 8 orders and production is tough to have a crystal ball on. But just know that there's that lag effect. So even if orders start to spike, that doesn't necessarily mean that in the next few weeks in terms of capacity.
And I did want to ask you, did you guys seem to be, was the market seem to be stabilizing to you in those weeks leading up to leading up to the winter storms that just threw everything into chaos?
I think stabilizing is a strong word.
Okay.
We're seeing some pretty strong freight volumes in January, and so I think we were, for the last few months, in relative terms, perhaps that would make sense to look at it that way. But I think even if you look at your charts there, the numbers even in the beginning of the year were just off the chart already. Right. So I would say stabilization is a very relative term there.
Yeah, that's a good point. I wrote an article a few weeks back where it seemed there wasn't much volatility in the market, but volumes were crazy, rejections were super high, and it just seemed that chaos had become the new normal, and we were just coming to expect and live with it. So that is a good point. That stable is definitely a relative term. All right, so let's talk about costs for a moment. There was demand and supply, so we'll talk about freight costs for a moment. So on the top chart you're looking at is the truck stop 7-day van rate per mile. That is inclusive of fuel. So this is a relative change. So the blue line is spot rates, green line is our contract rates. You can see contract rates are up mid-single digits. I think that's pretty much what I've heard, at least standard across the market at the very minimum. Mid-single digits increase year over year, and truck stop van rates per mile on the spot are up 50%, 60% year over year. Sorry, got lost in my notes here. So rates are, and then in the bottom chart, the bottom chart, blue line, you have ocean rates coming in from the U.S. from China, U.S. West Coast, and then the orange line, you have air rates from Hong Kong to the U.S. West Coast. So pretty easy to see that rates are up. Freight costs are soaring across all modes and everything. And the FreightWaves predictive rates algorithm, we recently updated it a couple weeks ago. It seemed that after the storm, in the weeks of the wake of the storm, that we would see a slow depletion or a slow decline in spot rates, but that obviously hasn't happened. So they updated the algorithm to account for the lack of deliveries and also the higher volume. So it's now projected to actually climb in the coming weeks. So the question to have spot rates peaked, I thought that was a clear no, but that doesn't seem to be a clear no any longer. Dennis, I do want to talk about contract durations. Have negotiations changed in that manner? I've heard a lot around the industry that shippers are looking to try to use mini bids, try to utilize shorter duration contracts. Has that come up in your discussions?
Yeah, I think any time that you're in a freight environment like we've been in, shippers are not in a rush to lock in that kind of pricing, and naturally. And so you're going to see more and more of that mini bid type activity. I think that the short-term contracts is definitely something, and that's one of those things that's kind of a risky proposition. Even though the rates are so high, it's really beneficial. I think from a shipper perspective to have great partnerships that are long-term partnerships, and then have partnerships that allow you to flex. And so, when it makes sense to use a mode, so rather than thinking about your mode mix in a siloed way, I think it's really, really beneficial these days to be thinking about, how can I best, and I think you're seeing some shippers really start to think about that, some retailers even start to think about how can I best optimize my mode mix to deal with this. And so it's not just a conversation about my truckload contract setup. It's really about, okay, we've gotten to the point now where we might be talking about mini bids, but then we're also talking about how can we rethink supply chain design so that I'm not as reliant on a really volatile spot market? And so all of those things are in play. And I think that's one of the things that is really important as retailers, any shipper really, is thinking about their supply chain. That's a tool that they need to have in their tool bag.
I agree. I'm sorry for not responding, but I noticed we're a little bit behind schedule here, so I'm going to try to get us through the end of this Q1 recap so we can get on to the trends. Here is the first trend, so it's a short-term trend. It's, of course, the port congestion, and we can have an inventory discussion here because in my quest to keep this puppy under 15 slides, I did not give a full slide on inventory, so we can have the discussion here. But obviously, it's extremely difficult to get product into the country right now, much more difficult than it was this time last year. Those that can front load, as Matt mentioned, they are front loading. Costco has been one that has said that they've been able to do this for some products, but not all. But most are having a lot of trouble getting inventory into the country. For a couple examples, Foot Longer inventory was down 25% year over year at the end of 2020. Nike's inventory was down 20% at its DCs, but up 30% year over year in hand. So that just tells you it is all stuck on the ocean in transit. And so it's just this. It's also a crazy environment moving forward with retailers because, as we've said, the prudence that they used in the back half of the year saved a lot of their years in cases. But now we have a chance where there's a lot of things to point to that could say we should be over ordering. We should be ordering a lot. There's the economy is opening up. Consumers are spending money. People are going to be out and about spending. This whole roaring 20s theme. So there's a lot of things that could entice you to do that. But the inbound ocean TEU volume index, that is the chart you're looking at the top. So it is at an all-time high currently, and we actually do a 7-day projection on it. It is projected to rise another 10% this week. People are selling stuff as fast as it comes in. Again, inventories remain extremely low. And so this is a point that the Ever Given was to international trade what the blizzards in the U.S., what the blizzards were to the U.S. trade. Both markets were seemingly finding, I guess stability is a little bit of a hard word, but a little bit of stability. The equipment availability was improving slightly, but things remained strained. So any action that would disrupt flows have an outsized effect. And that's what we're going to see from the Ever Given as well as the blizzards. But we're also seeing alternate routes. So this is people that are trying to avoid the port congestion. The things that they're doing, it's not always available to them, but they're trying to find alternate routes. This bottom chart is the inbound ocean TEU index by port. The port of LA is in blue. So it is up, 50% year over year, but you've seen a lot of growth in other ports, especially in the last just 2 months. The port of Oakland has exploded as people divert away from the port of LA and try to find somewhere to offload freight. Some retailers have also pointed to air cargo, but that is not an answer for everybody. You have to have very high value goods to do this. So, Dennis, how is ArcBest working with customers on their inventory? One thing is certain is that nobody really wants to hold too much of it right now. They learned in 2020 that holding less inventory can be advantageous, especially at the end of the year when you don't have to discount as much. But sales were left on the table in many cases in 2020 for the first time in a really long time. That has been outside of the realm of possibility for a long time, but that did occur. So what are your customers saying about inventories, and how are you guys filling the need?
Well, I think, it's consistent with what you're showing here in terms of the inventory situation that we see with our customers. And, I think it goes back to our ability to help really comes in our ability to execute as a logistics company with lots of different options, modes. We have an ocean forwarding operation as well that's working closely with customers on, getting their containers flowing through. Another option that we have is less than container load, where if you can't fill a container, I know there's a lot of issue right now just finding containers. So we've offered that product for a while. It actually plugs in quite well with our LTL network once it hits the U.S. ports. But I think just again, it's really about being able to deliver in a multifaceted type way, have a different conversation about how your supply chain is designed. We can help with that, and I think that we have seen our managed business has been one of the top growing businesses in our logistics company for a while, and that's just a place where we get to discuss a lot of options and then have the capabilities to fulfill behind that as we work through those options with customers. So definitely a lot of ways around some of these challenges. Some of them are challenges that they're difficult no matter how you slice it, and staying in stock is critical. But definitely there are options if you're willing to take a hard look at your supply chain flexibility there.
Matt, do you have any thoughts on port congestion, how retailers should be approaching this, given all the uncertainties? And on top of that, as a follow-up with inventories, given that there is some market share there for the taking, especially in apparel, where we've seen a lot of store closures over the last couple of years, how should retailers balance the desire to gain market share with also the cost that it may take to ship those goods and to sell them?
Yeah, I think how this will play out is going to vary a lot by retailer. For example, there's been a lot of, let's take Dillard's as an example, a department store chain. As earlier slides showed, that apparel sales have increased quite a bit because of the stimulus. But what's interesting is if you look at men's suits, for example, the companies that used to sell those exclusively, both brick and mortar and e-commerce, many of them went out of business. But people still need suits. There's some people that still need to wear suits. And, so Dillard's essentially has had a lot of their competitors go out. And so they have a big opportunity here. One thing, of course, Dillard's did is they shifted to like home goods and some other types of products. But in terms of taking advantage of the fact that some retailers aren't going to get products here, the key is to get, of course, air freight's difficult. There's a capacity issue there. It's not just cost. There's a capacity issue as well. But I think companies like Dillard's really could take advantage of this and use some air freight for certain products in their line.
Yeah, we've certainly seen Peloton and others use air cargo to try to alleviate some of the months-long delays that have been there for people that have huge demand for products. So the second trend in retail that are adjusting supply chains right now is that retailers are reassessing their existing fulfillment networks to better integrate their online and their physical operations. So this is a survey from Bring, their Bring Barometer 2021. It's a fantastic survey. It's free if anybody hasn't checked it out. So they did a survey of over 1,000 retailers to determine what fulfillment options people are adding since the start of COVID-19. Curbside pickup was the biggest. Over 50% of retailers have said to be adding curbside pickup. And another study that I found was from Gartner, which is very interesting. It's that as retailers are rolling out BOPIS, investing in curbside operations, many of them are also trying to pass along costs. And so what they're doing, and to do so, they are saying that, this might not be feasible to have next day delivery or same day delivery or even 2-day delivery. The costs are just insurmountable. So they did a study of 65 brands, of 500 brands, this is the second chart, that 12.5% from August 2019 to August 2020, 12.5% fewer of them are offering free shipping. 30% of them fewer are offering free next day delivery. So people are rolling back. I think retailers are finally coming to the realization that these costs are not worth the utility gained by customers. And I think we have seen a little bit of retraining of customers throughout COVID, which I'll come back to that point. But sorry for a little bit of formatting errors here on the change, but so ship from store became a very viable option for many. Retailers have been using this for a long time, but as companies try to move that endpoint closer and closer to the consumer, ship from store becomes a very viable option for many. But there are many costs in that, and the difficulties are abound. Dennis, you and I spoke offline about the effect of this ship from store, BOPUS, on my podcast last week. You want to touch again on just how LTL plays such a bigger role when you disperse these endpoints, whether it be to home delivery, but also to stores, how LTL can be agile and flexible in this market?
Sure. Well, I think, any kind of mode like LTL that's going to be able to allow you to move things in smaller quantities is really important. As you mentioned, these demand points sort of disperse, whether it's to the store or actually to the home of the consumer. I just think that, it's a win for consumers to have all the options. And what you talked about there is just just this grand negotiation, really, I think, between retailers and consumers about what does the consumer really want. Because the cost didn't magically go away, as you said, to deliver to a home during the pandemic. But I think it's been really, really interesting to see, and great for us as consumers to see the options that retailers have put on the table for us in BOPUS, and then just same day, next day, giving those options to us as consumers, I think is a big deal. But like you said, I mean, as these endpoints disperse, no matter where you're using the store to fulfill, or curbside or pickup in store, it's still going to likely require at some point in the supply chain smaller quantities moving to that endpoint, because the endpoints are gaining dispersion. So that's something that I think makes LTL pretty uniquely positioned in the mode mix right now, and really going forward. When you think about trying to predict things versus being flexible, there's a lot of flexibility there to be able to ship through LTL networks.
And sorry if I'm rushing a little bit, but I want to leave some time for Q&A. So localized fulfillment, again, moving those endpoints closer to the end consumer. So this is a study from Blue Yonder that I thought was fantastic. So they asked retailers what the challenges they're facing when it comes to the last mile of their supply chain. Overwhelmingly, the biggest biggest challenge is increasing costs. So I think these retailers are becoming more aware of these costs, because when you increase the speed, you increase the cost as well. So the next question is, which of the following options do you have in your network? So the biggest one is ship from store or BOPUS, the in-store fulfillment, 64%. Say they have this. And so automation, it seems to be making a lot of headlines across. You hear Kroger and the Ocado partnership. You hear Walmart with the local fulfillment centers, a highly automated system run by Alphabot. It is amazing, but those are still few and far between. The vast majority of retailers don't have access to fully automated warehousing like that. So let's get on to multi-speed supply chain. Sorry to rush everyone, but so this is something that I think it's recently been coined, the term multi-speed supply chain, but it's just the idea, as Dennis was mentioning, is of customers having options. It's offering everything that a customer desires, whether it be same day or 1 hour delivery, but also trying to find ways to incentivize the options that are most optimal for you. For your operation. So we've seen some very creative ways that companies do this, whether it just be through showing the hidden costs of delivery. There's a Mexican company named Coppel that has had great success with this. They just showed the additional carbon costs of shipping fast or shipping over 1 week, and I think they had 30% take the slower time. We've also seen Timberland. They offered just to plant a tree in their customer's name if they were to take a longer delivery time. 14% took it. So I think these are very creative ways that people are finding ways to elongate the delivery time. But offering everything seems to be a huge point of emphasis. This survey from Bring, so the Bring Barometer, they said that status quo will become that same day delivery will become the status quo in 2021. 30% are adding it, and I think 37% have it right now. So that make 2/3. And as Dennis mentioned earlier, third-party partnerships with supply chain operators are going to be critical in this multi-speed supply chain, whether it be same hour, same day. Gig economy couriers are going to be important, but also with LTL, with everything else, you're going to need great partners, and I think that's going to be a point of emphasis moving forward. Matt, do you have anything to add on multi-speed supply chains? I think this is, a developing thing. It's a new term that I've heard, but I think it's something that will be long lasting, and it's giving customers options, but also finding ways to incentivize the most optimal method.
Well, I personally think that buy online, pick up at store is going to remain much higher than anyone would have ever expected. I do think same-day delivery may become real important too, but there's a number of reasons people like buy online, pick up at store. But I think there's going to be a small number of retailers that get really good at it, because you've got to be really good at logistics improvement and supply chain management improvement, as well as distribution automation that we're going to see more of in the stores. But Dennis's point about a larger number of smaller shipments is going to certainly happen, because when you start using the store as a delivery node, you wind up having to have a wider assortment going through the store. And some of those will come directly from drop shipments, not necessarily from distribution centers. So I think there will be a larger number of small shipments as well.
This is something that I had somebody on my first podcast. He made a point of the Amazon Trojan horse. He said, don't get sucked into the Trojan horse of Amazon of faster and faster delivery, because that's the way that Amazon differentiates itself. And that's the way they're probably always going to be one step ahead of everyone else, just because they have the money to invest in it. So, but he also referenced a study that he said the vast majority of Amazon, I think it was 85% of Amazon Prime purchases aren't consumed until 3 to 4 days after they're ordered. Meaning that people don't always need, they don't need the stuff they're buying next day. They do it because it's free. Free shipping is an amazing offer that Amazon has on 2-day. I don't know if everyone should fight with them on that. So last one, this is the most important slide we will probably have. It is what has changed in COVID and what will stick. So as Matt mentioned, I agree with you wholeheartedly. I think curbside pickup and BOPUS are here to stay. I think they present the most utility to customers. I think about Instacart and the growth they've had over the last year with online grocery delivery growth. And I think that Americans weren't all of a sudden willing to pay for delivery because they wanted to, because they thought it was a good utility and they believed in the utility of it. They were willing to pay for the delivery because they wanted to avoid the stores. And within months, we'll have the need to avoid stores gone. So I think that BOPUS run, the curbside pickup, the weekly run to Walmart, Target, Kroger, that was already in Americans' routine. BOPUS allows you to cut down that routine time by 90%. At no additional cost. So I think that presents a lot of utility to customers. And also delivery, there are some hidden costs in that, some friction spaces in that, having to plan for when you got to be there when things get delivered so it doesn't get stolen off the porch. Timing and delivery is not always the easiest thing. So it's not always the easiest. But so in the short term, the trends that are going to stick, port congestion, that's not going anywhere. We have demand is expected to even pick up further from where it is right now. The stimulus boost has provided a boost to e-commerce goods that come into the country. Elevated transportation costs, as we've spoken, we don't see much downtrend in demand anytime soon, and the capacity relief that we see, we don't know how much of it's coming, and nor do we know when it will be here. So we do see, I see elevated transportation costs sticking as well. And then out of stocks, so this is also from that Blue Yonder survey. They asked, what e-commerce fulfillment challenges has your organization faced as a result of the pandemic? 53%, I believe, said out of stocks. That was the biggest point of emphasis. And those will continue, unfortunately, because of the port congestion and because of the bottlenecks in the supply chain. And this last chart is from Pitney Bowes. So they asked people what they are going to do more of or less of at the end of the pandemic. And shopping online, 30% of people said they would do 30% more. People said they would do more of it than do less of it. So again, that's just the point that e-commerce is not going anywhere. And then long term, I believe that retailers will seek returns on their investments that they've made over the past year on BOPUS and curbside, and I think they'll do that by passing on cost to consumers with faster and faster delivery, trying to incentivize people to use BOPUS and curbside. And then this is a point that Simeon Siegel, the analyst at BMO, made to me in our podcast. He said that consumers have been retrained backwards throughout COVID, and it's that prior to the pandemic, we were going from 1 week delivery to 5-day delivery to 2-day delivery to 1 hour delivery. It was a very fast line downward. Consumers were getting more and more. But then the pandemic hit, and I think consumers have also been retrained that maybe we don't have to have as fast delivery time as we once did before. The costs are just simply not are not reasonable. So that is, I think, that's something that I think I should divert you to the podcast, because I don't want to butcher his point on that. But I'll toss it over to you, Dennis. I think this is, a great discussion to have, and I'll just open the question wide open to you. Is like, what COVID-induced trends have you seen that you think have long sticking power? The ones on the screen or ones that we didn't mention?
Yeah, no, I think the ones on the screen make a lot of sense, and I think one of the most underrated things about how e-commerce has changed the way that we shop is now I don't wander around a store looking for things in stock. I'm going and checking online to see if that store has something in stock. And so that says something about, and then I'm deciding about, what kind of delivery method I want, or am I going to be swinging through there? And there's this level of convenience and visibility that we've gotten through digital supply chain visibility over the last few years that I think has really empowered the consumer to be able to make these kind of choices between what kind of delivery they want to receive or whether they actually want to go into the store and pick it up. But I think that's one of the things that as people have adopted online shopping over the last several months, more people, I should say, have adopted it over the last several months. It just changes that dynamic of having to go browse store shelves to find what you need. And so I think that one has major staying power for sure.
And Matt, to you?
Yeah, this out of stocks being the highest number there on your slide. I think the cost of out of stocks are higher than they used to be, and they will remain high as a result because of what Dennis mentioned, people having more visibility. So when you have a stock out, sometimes consumers allow for a substitution. But because of the increased and the rapid digitization of everything in retail, people have more visibility to their options. So I think there's going to be less substitution and more switching retailers. So this really puts a lot of pressure on retailers to figure out how to solve the out-of-stock problem.
Yeah, I agree. That's also a good point. When you talk about Instacart and how they have this, they've created a marketplace for online grocery where you can shop at multiple different stores kind of on one feed there. And it's very easy. There's no switching costs between retailers when you use something like Instacart. That's one of the reasons they've been able to grow so fast. So that is a very good point. Out of stocks do probably cost more now than they have in the past. All right. I think that's all I've got. That is all the slides. So, one last one, wholesale to DTC. This is the last trend. It's being led by some of the biggest brands in the world, Nike, Under Armour, Adidas. They are all moving away from the wholesale model towards more direct to consumer, trying to own more of the consumer process. And really just the battle between brands and retailers has never been more acute than it is right now, because both sides have so many options. For the brands, it's never been easier to own and operate your online sales channel. You can open up an online storefront with Shopify and a host of e-commerce technologies and really create a formidable Amazon alternative, pretty cheaply. And then it's also with lease agreements right now with all the vacancies, you can actually open up physical stores much cheaper than you have been in years past. And then also on the other side for retailers, there's never been more digitally native brands that are seeking offline homes than there are right now. And with capacity and manufacturing capacity open overseas, with especially apparel retailers cutting down on orders, there's manufacturing capacity open for private label operations. So there are options on both sides. The battle has never been more acute between retailers and brands. And I think we're going to see a year of experimentation. Lots of brands opening up smaller concept stores all over the country and population hubs. But this is another area, Dennis, where we're seeing a dispersion of endpoints. LTL will likely play a big part in replenishing inventories at these stores, especially given that they're going to be smaller concept stores in many cases. So LTL definitely positioned to take advantage of this trend as well. But that is the last slide I have. So we will open it up. I know we're a bit over time, Julia, so I don't know how long you want to give for Q&A, but we'll definitely open the floor. I'll toss it over to Julia.
Awesome. Yeah, we had some great conversations here. I know we ran over, but we want to be respectful of everyone's time. So what we'll do here is we will actually be able to respond to any questions that you have offline. You are still welcome to send them here in the Q&A, and we can provide those to our speakers and be able to continue that conversation. But we appreciate everyone for listening today. Thank you so much for ArcBest for partnering with us on today's presentation. Andrew Dennis and Dean Waller, you guys have all been great. Thank you for sharing your insights. We will definitely send this link to you all so that you can watch the recording, and that will come to you tomorrow. Thanks so much, and we hope that you join us again next time.
Thanks, everybody.